Welcome to the Time and Market Deep Dive. Just as a quick reminder before we jump in, this deep dive is strictly for entertainment purposes. You should always seek out professional advice before making any actual investment decisions.
Yeah, definitely. I mean, we're just here to look at the math today.
Exactly. And, speaking of the math, there is this fundamental law in physics that I think we all intuitively understand. The bigger an object is, the harder it is to accelerate. Like, you can't just strap a rocket engine onto a skyscraper and expect it to, I don't know, move like a sports car. It's just mass.
Right. Gravity takes over. The friction increases. It takes exponentially more energy to move something massive.
Right. But then, you look at the stock market. Specifically, you look at the software sector today, here in May of 2026, and suddenly we are staring at a company that seems to be completely defying gravity.
Yeah, it's pretty wild.
We're looking at Palantir Technologies, ticker symbol PLTR. I mean, this is a massive multi-billion-dollar enterprise. But looking at their newly released Q1 2026 earnings today, it's like watching a mile-long freight train suddenly hit Mach 2.
That's a great way to put it.
It's accelerating as if it just launched out of a garage.
Mm.
So our mission for this deep dive is to reconcile two warring narratives. You have this record-breaking business execution on one side, and then a valuation on the other side that is, well, it's making traditional value investors physically ill.
It really is. That tension is exactly why this specific quarter is so fascinating for us to dig into. We're looking at U.S. commercial revenue growth that is practically unheard of at this scale. We're going to look at agricultural and military real-world deployments.
Yeah, the boots-on-the-ground stuff.
Exactly. And then finally, we have to run a rigorous 7-year valuation analysis to see if the current stock price, which is sitting around $146, makes any mathematical sense.
Or if the market has just lost its collective mind.
Right.
Right.
Which is always a possibility.
So let's start with the top-line numbers, because I need to understand why Wall Street is reacting so violently to this report. Just looking at the broad strokes, total revenue hit $1.633 billion.
Yep.
That is an 85% year-over-year increase. And it's actually up 16% sequentially from just the last quarter. I mean, this is their highest revenue growth rate ever as a public company.
Which is structurally highly unusual. Typically, as a company matures, the growth decelerates.
Right, the mass kicks in.
Exactly. But this marks their 12th consecutive quarter of accelerating revenue growth. I mean, that consistency is exactly what is breaking the traditional financial models that analysts use to price software companies.
But the real story, the mechanism driving this, is where that money is coming from. Because the U.S. business is now the undisputed engine here. It makes up 79% of their total revenue.
Yeah, the U.S. is just dominating their balance sheet.
Overall, U.S. revenue grew 104% year over year to $1.28 billion. But the absolute crown jewel, like the specific number dropping jaws across the sector today, is U.S. commercial revenue. It exploded by 133% year over year to hit $595 million.
And, the underlying demand is actually even hotter than that 133% suggests.
Wait, really? How so?
Well, that U.S. commercial growth would have actually been 143% if it weren't for a specific government transition involving a major customer program.
Oh, wow.
Yeah, and because of this momentum, they've raised their full year 2026 revenue guidance significantly. They're now expecting between $7.65 and $7.66 billion. That implies about a 71% year-over-year growth rate for the entire year.
I have to stop you there because this is where that physics analogy comes back in for me. I understand how a scrappy little startup grows 100% when they only make, $1 million.
Sure, yeah.
You sign one major enterprise client, you hire a few more engineers, and boom, you've doubled your business overnight. But how does a massive established enterprise double its U.S. business? They are working off a base of billions.
It comes down to a very rare intersection. Market timing, meeting structural readiness. Palantir has essentially spent the last 2 decades building the complex plumbing for data integration.
Okay.
So when the generative AI boom really took hold, every Fortune 500 company suddenly wanted AI. But they quickly realized their internal data was just a chaotic mess of silos.
Like none of their systems could talk to each other.
Exactly. Palantir's AIP, their artificial intelligence platform, was already built. They aren't selling a flashy new chatbot, They are selling the foundational infrastructure that allows large institutions to actually deploy AI safely without leaking proprietary data.
So they were basically sitting there with the exact solution the second the market realized it had a problem.
Right. They captured the market exactly as it moved past the hype phase and into the actual execution phase.
Wait, but doubling revenue at this scale usually requires burning a mountain of cash on sales and marketing.
Yeah, normally it
Right.
does.
Like, you do not just grow 133% for free. Usually, when a software company forces this kind of hypergrowth, they are setting piles of venture capital on fire to acquire those customers. So what does their burn rate look like?
Well, this is where the Palantir story diverges from almost every other software company out there. They are not burning cash to achieve this growth, they are doing the exact opposite. They
Oh,
are intensely profitable, which brings us to the rule of 40.
okay, I hear Rule of 40 thrown around a lot by tech venture capitalists.
Hmm.
But for a non-software person listening, adding a company's revenue growth rate to its profit margin feels like mixing apples and oranges. Why combine a growth metric with an efficiency metric?
It's a great question because it does seem totally counterintuitive at first. In the software as a service world, there is this constant tug of war between growth and profitability. If you want to grow faster, you usually have to spend heavily on sales and marketing, which, crushes your profit margins.
Yeah, that makes sense.
But if you want high profit margins, you cut your spending, but then your growth stalls out. So the rule of 40 is basically a diagnostic tool to see if a company is managing that trade-off successfully. If your growth rate plus your profit margin equals 40% or higher, it proves you are scaling efficiently without buying your revenue at loss.
Okay, so it's the gold standard for a healthy software business.
Exactly.
Okay, so keeping that gold standard of 40% in mind, Palantir's Rule of 40 score for Q1 2026 was 145%.
It is an absurd number. I mean, to put that 145% in proper context, look at the other companies playing in that specific stratosphere right now. You have NVIDIA at 141%, Micron at 265%, and SK Hynix at 270%.
But those are hardware manufacturers.
Yeah,
Those are companies physically forging the silicon chips powering the AI revolution.
precisely. Palantir is a software company putting up metrics that are currently reserved almost exclusively for the hardware titans that are building the physical infrastructure.
Let's talk about how you actually get to those numbers, because the profit dollars here are staggering. GAAP net income was $871 million, which is a 53% margin. Their adjusted operating income was $984 million, a 60% margin.
Right.
How do you achieve a 60% operating margin? In hardware, if you sell 1 million chips, you have to physically buy the materials and manufacture 1 million chips. The costs scale right alongside the revenue.
That is the beauty of enterprise software, and specifically why Palantir's margins are expanding so rapidly right now. In software, you have what's called zero marginal cost of replication.
Okay.
It cost Palantir billions of dollars in R&D over 20 years to build the AIP platform, but deploying that exact same platform to the next U.S. commercial customer costs them almost nothing in comparison.
So the hard work is already paid for.
Exactly. Once that massive upfront research and development is covered, every new dollar of subscription revenue drops almost straight to the bottom line.
And we definitely see that in their cash generation. Adjusted free cash flow for the quarter was $925 million, which is a 57% margin. They ended Q1 with $8.0 billion in zero debt liquidity.
Yeah, $8 billion.
They are sitting on $8 billion of cash equivalents, and short-term U.S. Treasuries.
Which is massive. Having an $8 billion fortress balance sheet with zero debt means they are completely insulated from macroeconomic shocks. If interest rates spike or if credit markets freeze, Palantir really doesn't care.
They're bulletproof.
They can self-fund their operations, they can acquire smaller competitors, or weather any economic storm without ever having to dilute their shareholders by issuing more stock.
Okay, so the financial engineering is spectacular. The spreadsheets look utterly flawless. But I want to step out the abstract financial metrics for a minute. Let's look at the boots on the ground. What does this software actually do in physical reality to command this kind of money? Because the deal sizes are massive. Total contract value, or TCV, reached $2.41 billion, up 61% year over year.
In Q1 alone, they closed 206 deals worth over $1 million. They closed 72 deals over $5 million and 47 deals over $10 million.
That is a $10 million deal closing essentially every other day of the quarter.
Yeah, it's wild.
And those are just the new bookings. The metric that really caught my eye is the net dollar retention, which hit 150%, meaning the customers they already had last year didn't just renew their contracts, they spent 50% more this year.
Right.
And they have these whale customers, where the top 20 customers are averaging $108 million in revenue each over the trailing 12 months. Why are companies spending $100 million a year on this?
Let's look at the real-world examples from the Q1 report to answer that. First, they secured a $300 million contract with the USDA.
The Department of Agriculture.
Yeah. This is specifically for farmland security, supply chain resilience, and fraud prevention. In a government agency like the USDA, data is usually trapped in dozens of disconnected legacy systems. One database tracks weather, another tracks crop yields, another tracks subsidies.
Right.
Palantir is building a unified data architecture to integrate all of that in real time, allowing them to track and secure the literal food supply of the country.
That is massive. But then there's the military application, and this is the one that really stopped me in my tracks. They deployed something called ShipOS for the U.S. Department of the Navy.
Yeah, this one is incredible.
The earnings report notes that this software reduced key manufacturing approval processes from 200 hours down to 15 seconds. It also cut monthly material planning time by 94%.
That transformation is the result of what Palantir calls an ontology. It's their core mechanism for mapping digital data to physical reality.
Okay, let me try to visualize this ontology concept. Think of a massive bureaucracy like the Navy, not as a machine, but as a giant game of telephone.
Right.
An order is given, it's translated into an email, put into an Excel sheet, sent to a logistics planner, converted to a PDF, and finally sent to a manufacturer. Every single step introduces friction, loses context, and burns hours of time. Palantir's ontology isn't just a faster email system. It essentially removes the telephone game entirely, right?
That is a perfect way to look at it, yeah. Instead of passing fragmented data down a chain, Palantir creates a digital twin of the entire operation. Everyone, from the admiral making the decision to the foreman on the factory floor, is interacting with the exact same, constantly updating reality at the exact same time. The friction basically drops to zero.
Which explains the time savings, going from 200 hours to 15 seconds.
Wait.
I mean, you do not call that an improvement.
Yes.
An improvement is going from 200 hours to 150 hours. 200 hours to 15 seconds is a complete paradigm shift. It rewrites how the organization fundamentally operates. So going back to that 150% net dollar retention rate, I assume that when a shift like that Navy example happens, the customer becomes structurally dependent on Palantir.
That is the deepest moat Palantir possesses. When you integrate software that reduces a critical process from over a week of continuous labor down to a fraction of a minute, you are no longer just a software vendor.
Right, you're essential.
You become the central nervous system of the institution. If you try to rip Palantir out after a year, that Navy process doesn't just revert to taking 200 hours. The institutional muscle memory of how to even do it the old way is entirely gone.
Oh, wow. I didn't even think about that.
Yeah, the organization has structurally adapted its entire workflow to the new speed.
Yeah.
They literally cannot operate without it anymore. It becomes what CEO Alex Karp calls load-bearing infrastructure.
Load-bearing infrastructure. If you take out a load-bearing wall, the house collapses. Okay, so the business execution is flawless. The moat is deep. The margins are astronomical. But looking at the stock sitting at $146 today, I have a hard time wrapping my head around how any software company, no matter how revolutionary, justifies a market capitalization between $338 billion and $350 billion when they're only pulling in $1.6 billion a quarter in revenue.
Yeah, it's a huge disconnect.
Make the math make sense for me.
Well, identifying a world-class company is only half the battle in investing. The other, often more difficult half, is determining what price you are actually willing to pay for it.
Let's lean on a classic Warren Buffett analogy that was brought up in one of our sources today. In the short run, the market is a voting machine, but in the long run, it is a weighing machine.
Yep, a classic for a reason.
Right now, it seems like the market is aggressively voting for Palantir based on the AI narrative. But what happens when we actually put these cash flows on the scale?
To find out, we are going to walk through a rigorous 7-year stock valuation model pulled directly from the Everything Money Plus analysis in our sources.
And just to clarify for you listening, a lot of financial analysts might automatically reach for a 10-year discounted cash flow model.
Yeah.
But as our source notes, Palantir is growing so rapidly and the AI landscape is shifting so violently that projecting hypergrowth out for a full decade becomes pure guesswork. So we are sticking strictly to the 7-year model provided, because the 7-year horizon is a lot more grounded in reality for a hyper-growth tech stock.
Let's break down the parameters of this 7-year model. We're going to run 3 different scenarios for revenue growth: 12%, 20%, and a highly optimistic 30% sustained annual growth for 7 straight years.
Wait, 30% compound annual growth on a base of over $7 billion?
Yeah, I know.
That is mathematically terrifying. To sustain that for 7 straight years means they would have to conquer massive new sectors of the economy year after year. But okay, let's give it to them for the high-end scenario. What about the profit margins?
We're modeling profit margins at 30%, 40%, and 50%. And again, sustaining a 50% true profit margin over 7 years is essentially absolute perfection in enterprise software.
And what multiple are we assigning at the end of this, the price-to-earnings ratio?
Yeah.
Because right now, the market is giving them an astronomical premium.
This is a crucial concept in valuation modeling. You cannot apply today's hype-driven multiple to the future. In 7 years, Palantir will be a much more mature, established company.
Right, the hype has to cool eventually.
The initial AI hype will have naturally settled into standard business practice, and multiples almost always compress as a company's growth rate eventually normalizes. So the model conservatively assigns forward PE multiples of 20 for the low end, 25 for the mid-range, and 30 for the high-end scenario.
And finally, we have to discount those future cash flows back to today's dollars to see what the stock is intrinsically worth right now.
We use a discount rate of 9%, which represents a standard desired annual market return. And importantly, we are running this model with 0 margin of safety built in.
Not at all.
None. We are not giving ourselves a cushion for error. This is pure, unadulterated math based on projected cash flows.
Okay, the tension is killing me. What does the scale say? When you run all those numbers, revenue compounding at up to 30%, margin stretching to 50%, and a healthy PE of 30, what is the intrinsic value of one share of Palantir today?
Based on those future cash flows, the intrinsic value ranges from a low of $16, a mid-range of around $40, and an absolute high-perfection scenario of $100 per share.
Let me make sure I am hearing you correctly.
Sure.
Even in the absolute most optimistic scenario model here, where they sustain 30% growth for 7 straight years, operate at a staggering 50% profit margin the entire time, and still command a premium 30 PE multiple at the end of the decade.
Huh.
The highest intrinsic value the model can mathematically justify is $100.
That is correct.
And the stock is currently trading at $146.
Yes, it is.
So are investors currently just voting for the AI hype and completely ignoring the actual weight of the math? I mean, what is the final verdict here?
Well, it indicates that at 146, you are not just paying for Palantir to be a great company. You are paying for years of absolutely flawless, market-dominating execution entirely upfront.
Wow.
You are pricing in 0 mistakes, 0 macroeconomic downturns, and 0 successful competition for the rest of the decade. As the source analysis pointed out, Palantir is without a doubt worth a premium. It is a structurally phenomenal business. But the question every investor has to ask is, are they worth this kind of premium? And the 7-year mathematical model firmly argues against it. It's essentially a massive premium to intrinsic value right now.
To synthesize everything we have unpacked today, Palantir is a structurally phenomenal company. They are executing at the highest possible level. They are literally shattering the rule of 40 with a 145% score, proving their software scales with incredible efficiency.
Yep.
They have an $8 billion fortress balance sheet with 0 debt. And they are landing massive multi-million-dollar contracts that rewrite the operational DNA of institutions like the U.S. Navy and the USDA.
It's all incredibly impressive.
But on the flip side, the stock price is completely disconnected from traditional valuation models. To buy at $146 requires a belief that the company will not only maintain absolute perfection, but will effectively rewrite the laws of financial gravity for years to come.
It is the ultimate battle between a flawless business narrative and the cold, hard reality of valuation math.
Before we wrap up, I want to leave you with one final thought to ponder, based on something CEO Alex Karp said on this earnings call.
It is a quote that perfectly encapsulates the broader AI moment we are living through right now. Karp claimed that, and I quote, almost every single highlighted example of AI that actually is producing results in the U.S. is actually by Palantir.
Think about the immense weight of that statement. We hear about AI constantly. Every software company in the world has suddenly added .ai to their domain name and is promising investors the moon.
Right. Everybody wants in on the hype.
But if Karp is right, And those 150% net dollar retention numbers suggest he might actually be right.
Yeah.
If Palantir is truly the singular company moving AI from what he calls slop and hype into actual load-bearing infrastructure, what does that mean for the rest of the market?
This raises a massive question for you to explore on your own. If Palantir is the only infrastructure that actually works at scale, what happens to the valuations of the thousands of other AI software companies currently dominating the stock market?
That's a scary thought.
Are we looking at an AI landscape where it is not a rising tide that lifts all boats, but rather a brutal winner-takes-all scenario where Palantir absorbs the lion's share of the enterprise value?
If the mile-long freight train is taking all the cargo, the other tracks might be completely empty. That is going to do it for this custom deep dive into Palantir's Q1 2026 earnings. It is always a thrill to dig into a company that forces you to rethink what is structurally possible, even if the price tag makes you sweat. We hope this helped clear the noise. Because whether you are looking at the physics of a moving object or the momentum of a multi-billion-dollar tech giant, eventually you have to account for the mass. Until next time.